Hey folks, it's been a great start to the markets. We finally got some earnings coming out, and aside from green across the spectrum in my portfolio, the Canadian banks have finally started posting, and we got a little bit of insight today with Bank of Nova Scotia. We're going to go over some data that I think is just utterly fascinating on why you should probably be investing in the Canadian economy, because it really supports a lot of what I've been saying with the data we're about to go over, leading Bank of Nova Scotia to be the first of the Canadian banks to post earnings next to BMO today, but it's up 3%. So clearly these numbers were pretty good. Now, out of BMO, guys, they had just crazy revenue growth. It's up 39%, but it didn't really hit their bottom line as much. I didn't dive down into BMO earnings because it's not my favorite bank, but we're really going to fixate on Bank of Nova Scotia, which saw moderate revenue growth, still beating the analyst expectations, and the earnings beat by 11.22%, the best earnings beat in over a year here, folks. They've also increased the dividend, I believe, to $1.03. So after that pandemic lockdown where all the banks were basically just stockpiling cash for loan loss provisions, those days have come and gone, and we're finally back in the period of getting these dividend increases really consistently, which is nice for the Canadian banks because unlike the US banks, they didn't really halt on too much or cut dividends through that March 2020 like we saw with some of the US counterparts. But since 2012 here, I mean, BNS was paying around 55, 57 cents. So we haven't seen an exact doubling of the dividend in a decade, but damn, I'm still pretty happy with these increases overall, considering the history that this kind of goes back toward. But let's get into this, folks. If we go into Scotiabank, I opened up their earnings release here, and I'm not going to fixate on too much of the exact numbers. I just wanted to pull out data that I think specifically is really interesting, like the economic outlook in core markets. What this shows is the projected GDP growth, which is obviously highly reflected toward an upcoming recession. But what I want you to notice here is Scotiabank's projections for the basic GDP growth is actually projected to see Canada do better going through 2023 and 2022 this year than the US is going to see. And in fact, basically every foreign market from Mexico, Chile, Peru, Colombia, and I've kept stating this in the past, guys, that Canada is one of the fastest growing first world nations, not only by population, but clearly by that GDP that's hitting the bottom line here. So, I mean, just the gross domestic product is very important here for how these companies are going to perform, right? So when I look at these numbers here, this just, again, screams to me about why you want to own Canadian financials, Canadian major infrastructure companies, whether it's utilities or telecoms, because they should have a better projected growth rate based off GDP than, again, what the US is going to experience in a similar fashion here. So that's just kind of a little bit of an interesting factoid, I'm going to say. But taking a look at the interest rate sensitivity, another really interesting thing to pay attention to, because typically banks do better in interest raising environments, but it's a double-edged sword, right? Because if interest rates are higher, you're less likely to take out a higher mortgage on a property, which means there could be less mortgages. But reading into this, guys, they said an immediate and sustained 100% or 100 basis point parallel shift would have a negative impact on annual net interest income of $126 million for year one and a positive impact of $191 million for year two. And I don't really know how to take that information, but I'm kind of getting the idea that they're basically saying there'll be a short-term hindrance, but a long-term gain from the interest raising environment. Now, going a little bit farther from revenue growth, guys, it's really nice to see that the Canadian banking sector, quarter over quarter, basically coming out of Q2 of 2021, has seen positive revenue growth. So that's a bonus, which means clearly, things are still moving along. And we definitely see that in the loan growth for Canadian banking, because, in this interest raising moment here, where we're finally seeing the first few quarters of the impact, that they're still able to get loan growth, guys. And from an international standpoint, which I found very intriguing, mostly from the business standpoint when we're talking about international. But even still in Canada, they're still seeing growth pretty much across every spectrum, which is really good, even in the residential mortgages. So really good sign there, guys. The deposit growth, another really interesting one, is growing across the spectrum, not only internationally, but obviously in Canada here as well. So again, from the entire global perspective from banking, so long as people are socking money away, guys, the banks are going to keep doing well. And then finally, the 90-day past due loans. This is a real interesting chart because, again, interest raising environment, we haven't really seen the impact because most people's mortgages are obviously locked in for fixed rate, whether it's 3 years, 5 years, or 15 years. But it's nice to see, guys, that since the middle of the pandemic of Q3 of 2020, when they saw a 0.26% on 90-day past due loans, it's now dropped down to 0.1 or 0.15%, right? So that's the lowest it's been since the pandemic, guys. If this isn't a sign of, familiar robustness in the economy, I really don't know what is. This data, it makes me feel a lot better about where we're going. And it comes back to that whole thing I talked about yesterday with the doom and gloomers. Like, when you dig down into the banking and financial data, which I think reflects what's going on in the economy and in the economy the best, it just nothing here says, oh my God, the end is coming, even from an international standpoint with the exposure they have to Latin America, where obviously I would expect more hindrance from the international economic outlook when you're talking about places like Europe and just places that are more hip from the geopolitical circumstance. But outside of that, I think I'm going to sleep pretty peacefully coming into the next bank earnings. BMO did fairly good. Bank of Nova Scotia did really good. I can only presume that's going to do well for Canadian Imperial Bank, which is really largely exposed to mortgages, things like that. We got Royal Bank, Canada's largest bank. These are all coming up tomorrow. Toronto Dominion Bank. And then outside of the bank earnings, the only thing that I'm going to be really fixated on specifically tonight is going to be NVIDIA earnings, because we've seen the markets kind of go through this capitulation period, guys, where it hasn't really been related to the earnings, in my opinion, because these stocks go down whether earnings are good or not. I mean, Apple should be a good example of that. And the fact that NVIDIA, which I still think is a hard company to wrap your head around the value of it, because it's still even pretty expensive at this price, but trading down 50%, again, not really correlated, especially in the last, few months here, to those earnings. If earnings are really good and the stock actually rebounds or starts finding a bottom, I think it's going to be a really good sign that potentially the rest of the markets could be finally getting exhausted from selling off stocks, right? But again, I don't know. You kind of got to gauge this out over a long period of time. You kind of got to give it a good month or two to actually see how the markets respond, because even looking at, say, the S&P 500, we'll use VOO as the example here, guys. VOO hasn't recently rebounded or has seen its recent bottoms here. So it's kind of toying in this area where it's finding a range, but it's done this in the past where it can spend a good month rebounding and then go back into a sell-off. But if we can just get a good month period of bottoming, a little bit of hope where we get these consistent green days, I think it's going to be a good sign that as the volatility index starts to kind of simmer out, that, we're finally maybe getting to the latter half of the market's bottoming here. But again, I'm going to keep iterating that. I like spreading hope, and I hope that's what happens. But again, I don't want a quick rebound here either, because I like accumulating at these much more suppressed prices. But on that note, I pass the question off to you guys. I'd love to know what you think about all of this in that comment section below. Stay cool, stay awesome, and as always, I look forward to catching you in the next one.